Good morning, everybody. It's the Covered Call on Tuesday, December 29th, 2020. And I want to just talk about the market a little bit, show you another chart that looks a little bit like one that I've been putting up. This is from Forex Analytics, and they have a commentary out that basically says, since the financial crisis and all of the quantitative easing, the market has gotten less and less aligned with fundamentals. I think we all know that. And now we're at the top of a channel. And they're basically saying, look, this can come all the way down to about 2,800 on the S&P. Now back in here, they said it could come down to about 2,400. They were pretty right. And you can see all of these different support levels, not terribly different than the ones that I've drawn. When we get to the top of a channel like this, the best we can hope is that you just keep hugging the channel line up and the trend remains your friend. However, when you take a look at the angle, the pitch doesn't match this line. That should give you pause for concern. When things are asymmetric, what does that usually mean? Asymmetry is how you make big money on the upside, but it's also how you lose money on the downside. So a retrace back to the bottom part of the channel would get us to around 2,800, according to Forex Analytics. Here's my chart. I built a broad-kneed wedge from the start of the correction 2018, the end of the year correction. And you can see you do have an Armageddon scenario that's unlikely to play out, but it's not impossible. And that this broad-kneed wedge, we keep testing it. Tested it, came off, tested it, came off, tested it, have not yet come off. Makes you wonder if we're due for some sort of correction. What could change things? What kind of news could happen that would cause a correction? Well, on CNBC today and Bloomberg, they both talked about the Democrats winning in Georgia, which would change a couple of things. First off, the tax code would change. And I think it would change right away. And I think it'd be retroactive to 2021. So the market today was incorporating that news that it looks like the Democrats were up a little bit in Georgia, which is what I said a couple of weeks ago, is that, with all those votes coming in by mail, I wondered if the Republicans would get out the vote enough on election day. We'll see. At about 3 million mail-in votes, which are closing in on, the Democrats have a huge advantage. So we'll see if the Senate goes Democrat. If it does, expect a change in the tax code. I don't exactly know how they're going to change the capital gains. My suspicion is that they will pick a number. Maybe it will coincide with the Social Security taxation cutoff and say something along the lines of your capital gains are 20% up till $143,000, which means that it would basically ignore anybody who's a small investor who doesn't have capital gains over $143,000. What is $143,000? That is the rough number, and I might be off by 1,000 or two. That's where they stop taxing you for Social Security. So they could make it symmetrical. They won't. They'll just pick a number, but a number around there where the Social Security taxation goes away for people who are working, they could turn capital gains into income tax at that point and just change the definition without actually changing the rates. And if you're going to play smart politically, wouldn't you like to be able to say, I didn't raise income tax on anybody? I just got rid of loopholes. And I think that's a smart way for the Democrats to play it, is not change any of the rates, just get rid of some of the breaks for people who are making higher 6 figures and 7 figures. Because the capital gains at 20% for somebody making $1 million a year is pretty obnoxious. Anyway, would a change in the tax code stimulate a correction? I think probably. But on the other side of the coin, people are going, whoa, wait, but the Democrats will do more stimulus. They will, but it'll be fiscal stimulus, which means it drips into the economy over years and is better from the bottom up than it is from the investor class down. I expect this correction to happen to somewhere in the the lower 300s on SPY, lower 3,000s on SP 500. This is where you start to see buyers come back in. This is the level that basically Forex Analytics is pointing to. And this is if we get really bad news, which I don't think is very likely. I don't even know that this is very likely anymore. But here and here, I think we have to scale in. So when we look at individual stocks, what do we want to sell cash secured puts on? What do we want to write covered calls on? It's pretty clear that there's an awful lot of things to write covered calls on, and we're not all that close to being able to sell cash secured puts on many stocks. So sometimes you're going to look at your screens and go, not much to do. And I think that's probably where we're at. Let's take a look over at TradingView and look at the oscillators. It's pretty ominous divergence here, right? The moving averages are saying buy, 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 but we're getting negative divergences on the oscillators. Basically, the underlying aspects of the market are starting to break down on the longer term time frame. Let's take a look at the weekly. This one too, moving over. It's only on the daily. Today, this flipped. This was up here earlier today. So on the daily chart, we've gone negative too. I haven't looked at the market in the last 20 minutes. Did it go negative? Well, sure enough, it opened way up today. So you have negative divergences on the very long term. And on the weekly chart, which is the one I pay attention to, the oscillators are moving away from the buy signal. It's because we're up here. I think that 2020 is going to go down as a buy the rumor year. 2021, at a minimum, the market has to digest the valuations and let earnings catch up in the PE ratio. So right now, the PE ratios are way too high. Valuations are stratospheric, anticipating more earnings. So even with more earnings, you may not see a big jump in prices. It'll just be a return to a little bit more normalcy. I don't think we're going to see 16 PE anytime soon. But if the PEs are in the 20s now, you might see that get down to 20, 19, 18 as the E and PE rises, which means a small correction, maybe a little bit bigger, if there's some negative trade news. But my anticipation is that the trade picture is going to actually start going in the right direction. In the short run, President Biden will put some pressure on China, but in the intermediate term, he wants to cut deals with them to buy our energy and our food. And he knows that the supply chains are shifting anyway because of what? Machine learning that we've talked about over and over and over again. So let's look for stocks that are overvalued. Disney, we took a look at last week, I believe. So the January 170 is what we looked at on Disney. So let's take a look at Disney here again. Is it still overbought? Clearly, it's still overbought. I haven't updated these lines yet. Let's do one of those. So you can see on the weekly chart, your relative strength index is way overbought. I would tell you that if you own Disney, you need to trim some of this as well as write some covered calls. And if you are really willing to use these, not everybody is. A lot of people just get too emotionally tied to their stocks. Well, I made money on this, I'm going to keep it. Okay, but the technical indicators are telling you that it's breaking down. I don't think it would be unlikely to see this all the way back in the 150s relatively quick. So one of the things you could do is sell that January 170 call, trim some of your holdings. But if you really, really wanted to, you could try to see if you can get like a 155 put to sell as well. So you just go Disney over here at NASDAQ. The 160, I'm not getting anything for. So there's really nothing you can do at this point with Disney. The reason I showed you that is because we know that it's overbought. So you wouldn't expect to be getting much for the puts way down here. So trim this stock and sell some cover calls. Then as it gets back into the 150s, once again, take a look at your relative strength index and money flow. If it gets down in here, now you can sell cash secured puts or buy your position back. Remember, you don't have to be perfect. And I really want you to think about this here. If you sell some stock here and write some covered calls and the stock goes down, don't be so perfect, right? That's the enemy of excellence sometimes. When you strive for perfection, ultimately you have to pull the trigger. All you really need to do to win this trade is buy back your Disney below where you sold it. You're not trying to get the bottom. If you keep trying to get the bottom over and over and over again, you're going to miss over and over and over again. Build in several points of return by selling the covered call, trimming the stock, then buying the stock back as it drops. You believe in the stock long term. I do. I think subscription revenue is great. I think this is a company that does well as people start going back on cruises. Talked about cruises yesterday in the stock of the week show. I actually think that they're the best cruise line, but they're diversified. So Disney is something where it's probably going to come back down. It could come all the way down into the 130s. Make a lot of sense if it did, because you had that gap up. Question you have to ask is, these gap ups had to do with the streaming services. And those really are starting to drop a lot of money to the bottom line, and that's probably going to be permanent. So it becomes a valuation question, how cheap it can get. And I don't think that it probably gets way down there. In fact, we need to change our buy zone as a 0.5 line. I don't think we need these old. It's a whole new company now, right? That's what I think we're working with now. I don't think we're working with pre-streaming Disney anymore. This is the new company. So look at that. I fell right on that fib level. So in the 150s is probably where this is heading. And then you have a confluence there, a couple different lines. Then the ever important 168. And it happens to overlap another line, confluence. Confluence is important. When you have multiple fib levels, it's generally trying to explain the structure. So this line here is probably about as low as it gets. Lower 100s. Huge buying in here, right? And that gap here matched by that gap there. This might be wishful thinking. I'm going to make this a little wider because we don't really know how bad things can get when rumors have to be digested. And that's what I think 2021 is going to be. It really is setting up to me to be a lot like 2015 and 2016. A lot of chop for the next year or two, maybe, which means that we have to use the volatility to our advantage. So these overbought signals become more and more important, and they're always important. When you use the weekly chart, just to explain to those who are newer, that weekly chart means the Friday closing measurement, right? The daily chart, let me save that. The daily chart is the closing of the day. That's all. It's just when it's getting measured. It gets measured at the end of the week, monthly, gets measured at the end of the month. So the weekly is the one that really helps you identify those cycles, those position trades that last anywhere from several months, 6 months is common, to a few years, especially in these markets that have a lot of money getting pumped into them by the governments and the central banks. So here you go. Sell some covered calls and trim, and then wait for it to get down to here to start buying back in. Let's just show you what the chart says about its upside. Chart says 250s someday. Now, getting to here depends on the fundamentals. I don't know how fast their subscription service is going to grow, but I do think they're going to be one of the three big winners. The three big winners are going to be Disney, HBO Max, and AT&T TV, and then Netflix. Now, people don't believe me on the AT&T TV and HBO Max yet. If you're an AT&T phone user and you have an unlimited plan, go try out that HBO Max, which is free right now. And what you'll see is if you liked Netflix, you're really going to like HBO Max, especially if some of the television shows are shows that you like. And you log into HBO Max and all of a sudden, boom, you have Friends is there, Big Bang Theory, right down the list, The Sopranos. They've got a huge catalog. I think AT&T is going to have a chart like that at some point. So let's take a look at AT&T. AT&T has been in our buy zone for a while now. This is a pretty textbook case of a wall of worry, right? Once it gets through here, now people have to decide, well, it's going to keep going up. And what could create a chart like that just goes up like this? If they do well on their subscriptions. It is not hard to see this stock get all the way back up to the top of its range and then break out. And if it breaks out, $60, which is the price I've been telling you it was going to get to for about 2 years now. I've said that they're eventually going to break out because of the Warner deal, get to 60. So If this gets from here to here in 4 years or 5 years, you double your money on the capital gains, but you've also collected that huge dividend. I'm telling you, you need to own AT&T. Growth investor, dividend investor. Not a lot of risk down here, right? Go back a very long time. There's just not a lot of risk. If you already own it, take a look at their options for selling cash secured puts. Last week I said, take a look at the January 8th. And I actually think you can go normal, because what I didn't realize is that this one, you have to go into January 8th already owning the stock to get the dividend. So buy the stock so you get the dividend, because you need to own it before January 8th. That's when the ex-dividend date is. Then go ahead and sell in the money, right? This is in the money for the puts. Sell that $30 January 15th for $1.95. Stock's at $28.73 right now. You'll have a cost basis of right at 28. And if it goes up between now and then, you just keep the $2. You can go further out if you want. The reason this one might be important is because of the dividend. That should stifle the price just a little bit. You could go out to February if you wanted, get a little bit more money, not much. So keep it short. Then if it expires, just write a new one. Bar chart, which I use as my screener for the options. I've got my indicators. I want the daily to be in the right spot on the RSI. I'm using monthly and weekly expirations, 20 to 80 days. I want enough volume, and I want slightly in the money to out of the money. Out of 60 stocks that I have on this list right now, the only cash secured put it's telling us to sell is Alibaba. So let's talk about Alibaba, because last week it was on the list, and I told folks sell the February 235 on Alibaba. It's not listed on here right now, so let's look it up over at NASDAQ. Last week I had one of my brokerage accounts open. You take a look at that February 235, and it's $14 right now. Now, if you had put this order in, you probably got executed at the open at 11.90. That's what it opened at, the day that it dropped. So you're a little bit underwater on this, but the stock is already stabilized. And yesterday I said, if you wanted to nibble in, because the chart looked okay on Alibaba, just too big. So the commies were picking on Jack Ma for being a capitalist. So what I said last week is I don't think they're going to break up the company other than spinning off part of the financial unit. What was in the news last night and this morning? They're looking at doing a holding company for the wealth management units, the insurance company, the financial products. They're proposing exactly what I suggested, is they're going to do a bank holding company for all the traditionally bank regulated parts of the business. And frankly, I think that's a pretty good idea from a regulatory standpoint. The commies might be doing something right here. Suddenly, if we go to the daily chart, we can see we got right into our preferred or anticipated buy zone and started a jitterbug. Take a look at the 4-hour chart. Starting to get that buying pressure right there, right at a 618 line, kind of a confluence of a few lines. Came through the heavy selling pressure, right? These are people who bought before. When they lost money, they sold, and it ran out of sellers. So somebody asked me, those lines on the far right, why are these important? On the way up, it shows you where the buying pressure runs out, and on the way down, it shows you where the selling pressure runs out. So you had selling pressure in here, selling pressure ran out, and your new buyers started to come in. And these typically move up over time. So this area here is probably now a little higher. And that's why you're getting buying right here. Sellers sold themselves out, price volume went away, started to find some buyers. So in normal times, these fibs would be important. And then this buying and selling pressure is important. How normal is it with what's going on in China? For China, I don't think it's unnormal. I think for America, it would be abnormal. Could Alibaba have one more leg down if the regulators decide to take one more shot at them? For sure. But ultimately, China needs this company to survive. They're almost overbought on the weekly chart. MFI, same thing. Weirdly, shaking money flow didn't take much of a hit. Your MACD still heading down, but after today, and if it keeps chopping along, this is going to level off and turn back up. So we'll have to see. I haven't checked to see how many days it's going to take to do that. But usually you're talking just a few days, 6, 7 days right in there, 8 days. Could be 9 or 10 days, but that would be a little bit long for the MACD to change like that. So if he's making peace with the regulators right now, Ma, and they spin off the wealth management division, then what this is telling you is that you don't have a lot of downside risk anymore, maybe 20, 30 bucks, but your upside still way up here in the 500s. And I believe that this is going to be well over $1 trillion company at some point, which would put it up around here because it's at like 600 billion right now. This company should be bigger than Amazon in the long run. How long is that? I'm not sure. How big will Amazon be in the future? I'm not sure. I said, 4 or 5 months ago that I thought we might be at peak Amazon. That's an article I should write because it's a great title. The emerging markets are skipping a lot of the things that we're doing in America or have done in America. Why? Because the technology is different. They don't have to drive as many gasoline cars because the EVs are coming. And the news on EVs in the last week has been amazing. You're really not going to see a lot of gasoline-powered cars sold after 2030. But just like they're skipping a phase on automobiles, they're skipping a phase in communications too, and in how they shop as they become more middle class. They're not going to have as many malls as we do. They have malls, they have mega malls, but they're not going to keep building them all over the place. Why? Because so much has changed with internet buying. So these companies that can sell from centralized distribution centers and just have a showroom here and there, they're going to do really well because the margins stay higher because we're already conditioned to pay certain prices, and most of any price drop is minimal compared to the expansion of the margin. So if something costs somebody $10 to make and they're selling it for 15, and to get more sales, they can lower it to 14. But because they closed stores and did most of it online, now their cost is 7. They're keeping $2 there and they're giving you 1. This process hasn't played out yet. It's going to be a while before the margins head in the other direction. I'm not sure how long, a decade, maybe 2. But retail, just like industry that uses technology well, is going to do amazing, which means the cloud has to get bigger and bigger. And who's one of the biggest cloud players in the world? Alibaba. They are to Southeast Asia and especially China what Amazon is here. And if the Chinese are smart, and generally the party has some brains, they'll realize that to get wealthier and wealthier, they have to make some concessions to the rest of the world to keep being in the club and to get companies like this to keep going up. And I'll tell you, this buying right here, right before it happened, I told you I didn't think it'd be surprising to me if the Chinese communists started buying stock, right? They missed it. So they beat it up. Now they're buying it back. And the only thing that's going to change is some lip service and a holding company for some of the financial services. So I think you can sell cash secured puts on this one. And I do actually think that a starter position right now makes sense if you don't already have one, and then sell an out of the money put. And we know that about 175, 180 is probably as low as this goes. So you probably want to sell about a $200 put. No, maybe a little lower, depending on your risk tolerance. Something in here. A February 200 gets you a cost basis under 200. You could go all the way down to the 190, which is probably a better deal, right? Because at a $200 strike price, you're going to get 375. And 190, you get 250. So that's only $1.25 less, but you're lowering your strike price by 10 bucks. So I would probably get a starter position in Alibaba right now and then sell the 200 or the 190, depending on how much, how you want to scale in. Let's take a look at Nvidia, another one like CCI and EMT that we looked at yesterday that is rolling over. How far down can Nvidia go? You know, like I said, the middle 300s makes a lot of sense. You have some sellers up here, then you have this gap in here. So unless the buyers move up, that's a gap that probably stock probably falls through there. I guess I'm buying right around 400. So even though there isn't a fib line there, if we put in a fib here on the speculation that this was a top, do we wake up and have a fib line that coincides with that volume? No, it goes right to the same spot. Then this one goes up just a little bit. So the chart says a little bit under 400 for an Nvidia. But 400 is a pretty psychological price. So I would probably be buying right about there, about 420. Why? One, the psychology of it, and I don't want to miss it. And two, there does seem to be some, you can see it. There does seem to be, and right there, there's some buying. So Nvidia, a little over 400 is where I think you have to really start thinking about it, which means there isn't a cash secured put to sell. Unless you just sold out of the stock, in which case if you wanted to sell a 490, go ahead and sell a 490 or even a 495 for a 500. Because again, you don't have to pick the bottoms. You just have to create a difference between where you bought and where you sold. So let's say January 2021, the regular monthly 500, get 865. Again, another psychological number. I think we go under this one. Could do a 505 if you want to stay above the psychological round number, which they actually matter. They shouldn't, but they do because we're emotional things. So if you just sold Nvidia and you want to figure out a way of starting to scale back in, maybe a third of what you sold you do here. Now, and I know that not a lot of people are trading this big with Nvidia, but for those 7-figure accounts out there, this is something you can be thinking about. If you rode Nvidia way up and made a ton of money, sold it in the 530s, 540s, whatever, and you're like, hey, I can just put a gap of around 7, 8, 9% from where I sold, and when I start to buy back, you write this one, then maybe you write you wait to see if it goes down towards 420, 430, you write another one, or you just buy. So here's a stock that I'm researching right now. Always make sure to keep 2018, that's an important year. Why is 2018 an important year? Nobody want to take a shot at that? It's because we had all that volatility events in here and then the big sell-off at the end of the year. So this is a mall REIT. I hate mall REITs, but I like the real estate that they're on top of. And these guys started to rally kind of with the whole market. Pretty reasonable that they would come down. But these are some of the best malls in America. And I think that they're a little bit more pure than Simon. Why? Because Simon is now dabbling in buying stores. And the fact that they bought JCPenney instead of letting it go bankrupt, I just think it's just such a horrible, bad decision. JCPenney's not coming back. I mean, if one of the old department stores was going to come back, it would be Sears. But both companies have been destroyed by the hubris and unwillingness to adapt of the people who ran the companies over the last 20 years. So these properties are really good. The balance sheet isn't so good, but they've had this basing pattern for a while. There's pretty heavy buying down here. So I think this is one where you could start looking at selling cash secured puts. Somebody asked about this stock, but not much of a market for the options. There's nothing. Wonder if that's right. Does anybody not own enough gold yet? Do we need to cover any of that? There's no premium in this really, which means that a lot of people believe this company is starting to come back. So I would just keep an eye on this company. I haven't decided where I'm going to put it on our lists, but maybe you take 20 minutes to read their corporate presentation, just get familiar with it. It's an interesting company. All right, any symbols to take a look at? The covered call screener is telling you to trim some Apple, some Disney, some EA, Freeport-McMoRan, Microsoft, Taiwan Semiconductor. We talked about all these already. So the article this week, I'll probably have an expanded how to use the RSI and MFI. Even though there's a whole article on it, I'll probably pull some of that out and then put it up to the free side of Seeking Alpha too. I'll probably talk about the market in general because I agree. I think we see a correction to around 3,000. I don't know if it's a little above or a little below. These buy zones are fairly close to each other. Yes, the plug and play list will reflect exactly what I want to own if we get this correction for the Biden administration. And I will tell you, if the Democrats get the Senate, then those infrastructure plays, get some life again. So between the sustainable world investing and the infrastructure plan that would come, we need to start taking a look at different things. And I had looked at CMEX a while back. I haven't looked at them lately. So back when they were down here, I was telling people, hey, we should take a look at this. And but this is a company that does really well when there's a big infrastructure deal. So we should be looking for an aggregates company, whether it's this one or Vulcan. So Vulcan already rebounded. So I don't know that there's a lot to be done in cement, but I will tell you, there is new cement coming. Crazy weird, right? Yeah, this whole chart is just going to get redone. All right. There are companies out there. If you look up Bill Gates, what you find is that he has some investments in companies that make cement with a lot less pollution. So the cement industry is one of the biggest polluters on the planet. So technology that can improve that probably be a good place to look. I haven't done it yet. I just know that's where I need to find some time. All right, everybody have a great rest of the week and have a happy new year. We are going to do a show on New Year's morning, and that'll be the big forecast issue. Take care.